Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Okay, hi guys. Welcome back to lesson 9. Now it's been quite a journey and it's going to continue to be quite a journey. If it's your first time dropping in, I know I'm doing these courses for YouTube, so it's completely free, and as a result some of you are going to jump in at lesson 9 and you need to go back to lesson 1. In fact, you need to go back to the introduction so you can get the idea of exactly what it is I'm doing here. So if it's your first time here, welcome to the channel first and foremost, and I hope you enjoy the course if you choose to go back to the introduction and start from there. Do not start from lesson 9 hoping that you're going to learn something. That is just not how it works. When you're doing a course program, you want to start from the beginning and then come to the end. Anyway, for those of you guys who've been following me through from the introduction to lesson 1, you know I'm doing the biggest project here, which is pretty much teaching a multi-asset approach to financial investing and trading. So, of course, if you start this program and you go with me all the way to the end, which is going to be several lessons down the line, you are going to have a very, very holistic idea of how financial markets work. I will be providing as well a lot of supporting material afterwards, so I'm going to dedicate the channel to just a complete learning experience. So, sorry. The one thing I'm going to ask everyone who's watching this right now, and you've managed to stay tuned in, that you share this everywhere. Share this with your social, share this with everybody. It's the only thing I ask, right? The more you share this, the more you like, the more you subscribe, the more you comment, whatever, the more engagement we get, the more people are going to find out about this. We all know this is how the YouTube algorithm works. So again, this is a course, so it's not going to have a tremendous amount of reach. It's really going to be down to how important you guys think this is, right? So I'm relying on you guys for the upvote. But in any case, let's press ahead. So in this particular portion of the course, we are going to talk, because now, of course, as you know, we've covered stocks. We are now covering Forex. So we're going to talk a lot about it. I have my opinions about what I think about Forex. Some of that will come through as I teach. As a trader who has had more than 15 years in this business, I've traded everything, right? So I'm not really what they call asset class agnostic. I genuinely do not care. I follow yield. I follow where the money is, right? So if there's a play to be had in Forex, I'll consider it. If there's a play to be had in stocks, I'll consider it. And for those of you guys who follow me know that I sell option premiums. I play with CFDs. You also know that I have a stock portfolio, which is doing astronomically well. And again, if you haven't seen my P&L proof at the beginning of all of this, you should go back and look at it. So I'm not blowing smoke out of my ass, right? What I'm essentially trying to do is help you guys to get to a level. Some of you are going to surpass what I can do. Because again, we're all different. What we all need is a ramp up. We need someone to help us to get to the place where we can start to put our own input in. You know, I always say to guys that I will be incredibly surprised if you guys were still following my strategy or my setup or my coursework, 2 years even down the line. That will be astonishing to me. So I would assume that most of you guys would have genuinely moved on, and you would have been able to sort of, build maybe your own asset management firm. You might be able to build your own ideas and sort of overlay them with what I'm teaching you here. But the one thing I will say though is that what you're going to learn here, you're never going to hear anywhere else, right? No one's going to tell you this stuff. And that's the point of me doing this, is that I want you to know the real deal, right? It's not just about someone telling you to go trade this, trade that, where you're going to make millions of dollars as a trader. This is bullshit. What you really need to know is that this is not easy. And I'm going to show you what you need to do. It's not going to be easy to digest, but it's definitely going to be worth your time. But anyway, some of you already know that. But in any case, let's press ahead and get on with the rest of the course. Okay, so let's start step one. So I've decided to push into the day trading aspect of Forex because in the last lesson, we spoke about Forex broadly, right? If you're a swing trader and how to sort of, step-by-step position. So once again, we're going to talk about this almost exclusively from a day trading point of view, because there is a slight disconnect. I mean, of course, I hear this all the time, and we're all guilty of this, the top-down approach. Work your way from the higher time frames to the lower time frames. And that's perfectly fine with an asset that is not as crowded as Forex. Now, you guys saw in my stock program, I did a classic top-down approach, and I showed you how to do this properly. We went from the monthly, and then we came all the way down. And you can clearly see that at some point, we might not, depending if the stock is really liquid, you might want to go to 5 minutes. But you can see through my whole program, I discourage the idea of trading that deep intraday. That's just something I more or less discourage. However, in this scenario, you're going to find that if you're trading Forex, you're going to spend a lot more time trading tighter time frames. But even at that, I give you a limit. So we're going to go step by step, and we're going to work through how you would do this. Now, for people who say that just do the top-down approach, go from the monthly, weekly, daily, and so on, that's great. You do need to develop a bias, and we spoke about that in the last lesson. But there's a point where that upper time frame doesn't really matter anymore in the intraday, and you're going to soon see why, right? And with me, I'm big on proof, as you already know. So if you already had a bullish bias, say on cable, and then you were trying to play that into an intraday because you saw the price go up, then you're going to get crushed. And I'm sure that a lot of you have had this experience where it looks like the higher time frame is telling you this is going higher. You get into the intraday, you take a long position, you get whipped out of that position, and you're dead, right? And then the market still goes higher. I'm sure you all know what I'm talking about, right? So this is the kind of stuff I'm going to teach you how to navigate. So let's start with step one. So first and foremost, you got to understand your bias on the longer time frames. Again, when I say understand your bias, you kind of have to have an idea, but you don't want this to be your be-all and end-all. So just think about it. You want to have a bias from a higher time frame from where you're currently trading. So again, locate all prior day highs and lows to identify stop loss areas using the 1 hour time frame. And again, I'm going to show you in the next couple of slides exactly how this works. So everything we talk about here, you are going to be able to have a picture perfect look at how that's going to play out. Step two, you want to only trade from the European session. So, well, essentially, if you're only trading from the European session, I should say, right, you want to locate the Asian high and low prices. Now, personally, and I'll say this, and it depends on the asset you're trading. If you're trading cable, you want to trade this in the European time frame. Perhaps if you're trading dollar peso, for example, you might want to trade this in the US time frame, right? So, but what you find with currencies, the correlation is so high that you're going to see dollar peso moving in the European session, right? So what I like to say is that with the exception of maybe the yen pairs, say dollar yen, for example, dollar peso, maybe even dollar CAD, I will stick to executing in the European session. When we run through the examples, you're going to see why. Now, also, you're going to find that there's some great opportunities in the US session, and I'm going to teach you how to exploit those, which I think you'll soon start to build a picture, right? So again, trade only from the European session, so locate the Asian high and low prices, right? Now, if trading in the US, and when I say US, i.e. sort of now pushing into sort of the NASDAQ Open or the Chicago Open, now this is pushing further in out of the European sort of time zone. So if you're trading in the US, identify the Asian and European highs and lows, and we'll also talk about that. Now, and you know exactly the reason why I say this. If you haven't done the other lessons, go back, because I talk specifically about the importance of centers in Forex, right? And where a lot of the business is done. Now, step 3, identify high volume candles on the 1 hour time frame. Breaking of these candles will trigger stops on the nano and micro price levels. So what do I mean by that? So you want to look for very extreme float rotation, and I'll show you an example. So when I say float rotation, I mean very extreme tick volume. You want to be able to see that tick volume really expand, right? And that gives you an idea, and I'll show you how to systematically read that. Now, once we see a candle, we see its volume, it's incredibly high, and then we start to see price probing underneath the lows of those candles. What you're going to get is a lot of stop triggers, right? Because when a candle forms on a time frame like a 1 hour time frame, it is not too big a time frame, it's not too small a time frame, it's just perfect. I don't like the 30 minutes, it gives a lot of noise. The 1 hour time frames are just perfect, because they're especially in Forex, they kind of give you the complete picture for an hour, right? And when you think about how many traders are going to have been taking positions in that, when that 1 hour candle closes, they're going to be a lot. And when the market moves against them, they're almost the quickest to exit, right? Because that candlestick has a lot of information, because it's an hour worth of information as opposed to 5 minutes or 2 minutes or 10 minutes or 15 minutes. We're talking about an entire hour, right? So when we start to see stop triggers on that time frame, we're going to start to see algo stop triggers on the nano and micro price levels. Now, step 4, taking profits. Now, we want to be able to take profits by the next liquid trading session, right? So let's say, for example, you took a position in the US session and it goes in your direction, right? You want to wait till maybe Asia or Europe the next day in order to get out of that trade, right? Because that's going to mean that you're taking liquidity from one time frame. So once you've got into a position, you're going to exploit the liquidity in the next market open setup, right? So that's why we do it that way, because again, a lot of people might put a hard target and say, I'm looking for 3 to 1, but whatever, right? But what we do know is, and if you remember my section on the probability of ruin matrix and what I said to you guys in terms of where I want to sit in the matrix, if you don't remember that, go back to that lesson and rewatch it. However, we want to ensure that we are getting out at the strongest liquid places where we're getting the sense that the market is going to maybe move against us again or go in a different direction, but it's not going to happen largely before a liquid center. If you're right on your direction and your position, there is no point taking a position in the US session and then getting out in the same session, right? Because 10 chances to 1, unless you've got a really weird day where there's some news and the market moves in the US session and you get several, like a huge move, and we'll see some of those examples, right? You're probably not going to be in a position where you want to take profit. And even if we do get those huge moves in one session, you have to ask yourself, well, you know, if this continues, say in Asia, for example, then you're going to get an even bigger expansion in Europe. And in some cases now, that's where the liquidity will come in. So you would be able to easily identify if this market is, trading volatility that is equivalent to, say, 2 trading sessions. You're going to be able to see that. So let's say, for example, in Asia, you get a big move, right? And in Europe, you get a big move in the same direction, right? Then in the US, you get a big move in the same direction. Now you've got 3 liquid trading sessions all going in one direction. What do you think is going to happen in Asia the next day? Whole thing's going to collapse. So you'll be easily able to detect that there's a bit of an anomaly here and the market is doing something that it doesn't normally do. All right, so let's jump to the proof, right? Because this is obviously, we're going straight into it. I planned not to talk a lot because we're going straight to the proof, right? We've done the Forex in the previous lesson. Now we're in the day trading section. I want to show you guys how it works. And we're going to take a lot of the principles that we learned and we're going to put it in there. And guys, like I said, no one will tell you this, right? This is the shit they don't want you to know, right? Because once you start trading and acting like this, it's going to reduce the amount of money a broker can make off you. He's going to have to work harder to get newer clients, newbies, people who don't know what they're doing to come in and trade. He's going to be very aggressive in terms of finding people. Obviously, prop firms and all these people work on the same principle. They're going to get really aggressive in finding people who don't want to trade. They're going to get who don't know how to trade. They're going to get really aggressive in terms of pushing people out of their ecosystem who are really good at it. So again, guys, don't be surprised if you start kidding numbers. Your broker tells you they don't want you in their brokerage, right? Or you're doing something scammy, or they're going to throw some terms and conditions against you. These days, you don't see that as much with brokers, to be fair. You know, I always choose the ones that can handle the pain. Obviously, for those of you guys see, you know, I've got an account with IB, for example. So brokers where they do clean execution, they handle the pain. And then you got the ones who don't handle the pain. And if you watch my previous lessons, I've advised everyone strongly against dealing with people who can't handle the pain. And that's small, greedy individuals who are just grabby and they just want your money, and they say they're running a brokerage, but really they think that you are a lamb to the slaughter, or a pig to the slaughter, as we say in the business. And you're not a pig, right? So don't act like a pig. So the point here, guys, is that once you start to use this stuff, expect that there's going to be some pushback, right? It's not going to go easily for you. If you're trying to do this for a prop firm, don't be surprised if the prop firm shuts you down one day and says that you're doing something nefarious. All right, back to the thing. So proof number one. So the first thing we've always spoken about is, so here you're looking at, so let's concentrate on the 22nd of November to the 23rd midnight. So this is one trading session. So midnight, market open, right? And then onto midnight, the next session. I've deliberately used midnight. Now, obviously, if you live in London, it's 10 o'clock. That's the Forex market open. But there's hardly any liquidity then. So really and truly, everything starts moving at midnight. So I tend to disregard, and I just say, let's say the market opens at midnight, and that's that, right? And I'm going off GMT time here, right? So midnight. So for me, I'm looking for the Asian high, right? So you can see I've drawn a line here to indicate the high of Asia high. And then as the session's traded on, I've highlighted to show the European low because this was in Europe. So if we think of this as midnight, and this I think was roughly about 9 o'clock in the morning, for example, you can see that. And it's very easy for you to detect. So you can see how this setup is. So this is what I'm looking for. I want to make sure that I can see this. So I don't want to trade in Asia. I don't want to start trading before Europe. So as I said before, start your trading from the European session. Don't trade in Asia, right? Doesn't matter. Now, of course, there are moves there, but you don't have good information, right? You can try and front run the market, but I mean, it doesn't really work. So I wouldn't really do that because, as you can see, the market swung back really fast. Now, what you see a lot with Forex is that in Asia, if the market sells off, in Europe, it will rally against the Asia. And in the US, it tends to rally against Europe. And then on the odd occasion, you would see the market going in a singular direction, right? And that's obviously very bullish. And then that tends to play into much longer time frames as well. Now, what are we looking at, right? So let's start step by step. Let's start with this step here. So here you can see I've put green, which is always to highlight their stop losses under here, right? So I've got a green arrow. So you'll see this as part of my infographic that I create on the charts. This is stop loss area. Why is this a stop loss area? We've spoken about this before. It's a stop loss area because it's a significant low. The market has long left that low and stop losses are likely to be here. Yes, some people will trail their stops as they go. So these levels are also going to have stop losses. But here is where all the stubborn stop losses are. And it's also where people who are looking to sell are going to put sell stops in here as well. So you're going to have sell stop loss here, sell stops as well. So you're going to have a cluster of sell stop orders. That's the bottom line, whether they're stop losses or they're sell stops to execute into a trade. And if you're not familiar with order types, go and check out the other lessons that I've done where I've covered order types in detail that you would expect to see. So that's the first thing. We've got stop losses centered under here. So this is going to be a key area. What do we say is where stop losses are? So just below the stop loss area, what do we find? Liquidity, right? Why is there liquidity? Is because so many of these orders are going to get triggered as soon as we hit bid prices into these zones, right? Market sells, the market sells to you at the bid, right? Or rather buys from you at the bid. You sell to the market at the bid. So there's going to be stops down here, right? So the moment we see bid prices coming under 124.61, we're going to start to see stop triggers, and that's liquidity, right? So once all those sell stops have been filled, it means the buyers are buying at the cheapest possible price, which are of course the main market makers, the smart people in this business. You've sold to them at the cheapest possible price at a time when you were supposed to be buying. It's the way of the business. That's why retail traders lose so much money, is because they're always selling when everyone else wants to buy, and they're always buying when everyone else wants to sell. Right? It's how the system's designed. As a result, we need to be paying attention to those areas where we're going to find liquidity. And guys, don't worry, all of this that I'm showing you, it's very difficult for them to change, but they're always trying to change it so that if everyone's not going to do this. This is the bottom line. If you look at the amount of views on my video, they're not a lot of views, right? Compared to, some of the influencers on here have hundreds and thousands of views because they are doing a video format or recording format that YouTube algorithms prefer. But that's not how you're going to learn, right? You're not going to learn from listening to some guy telling you how many millions he's made trading. It's clickbait. It's great. It's a great entertainment. But that's not going to help you if you're an aspiring trader or an investor. I mean, if you're just in it to laugh and have fun at people in the markets who are not very successful, or that the person you're listening to is a scammer, or and he's just funny and you're tuning in for that, that's great. But those are the things that get promoted on social media. So as a result, hence the negative feedback. You don't need me to tell you that. So the reality of it is that not a lot of people are going to see this. So me telling you this is actually going to have zero consequence to the rest of the market. No one gives a rat's ass, right? No one cares. So what I'm showing you here is just completely, if you're seeing this, you're lucky, right? You're the fortunate one. And half of you, in fact, more than half of you, are going to stay to the end of the video. You're going to say I talk too much. Well, and that's why I designed it this way, so that I can keep everyone's attention span a bit more stretched. Because if you're going to be a trader, you need to have attention span. If you don't have that, it's going to be challenging. Yeah, so I can appreciate that, right? But again, it is what it is. If you're seeing this, like I said, you're lucky. So you can clearly see here that we got stops under here, and that's going to attract liquidity. Right, so we want to make a note of where those stops are. That's the first thing, right? And we know there's stops over here. That's going to attract liquidity. So wherever we see highs that have been untraded, they're likely to be stop losses there. So we want to pay attention. Also through the day, so we know there'll be stops over Asia, for example. We can also see through the day when we push the European low, there are going to be stops on the European low as well. So this is all about intraday traders at this point. So what happens through the course of the day? We sold off in Asia. We posted a European low. That's a point of interest. Stop's going to be under there. And then we drove up, and then we attracted some liquidity to the highs, right? So just sellers intervening. We didn't really trade above the high, so we didn't really hunt for liquidity. I think the market was just very much in the short mood. So it just headed much lower. Now, what are some of the key things that we're seeing within this session in terms of the volume that we've been talking about? So when you're reading volume, you're looking for extreme volumes that are extreme relative to the session. So for example, you can see at midnight, 1 a.m., we had some extreme volume, which is quite high for this session. And then quite clearly, as we pushed into the European session, to the early half of it, we saw again another extreme high to match the 1 a.m. high. That's normally an indication of the Asian traders short covering or covering their short trades because they don't plan to trade into another session. So you're always going to see peaks in volume at the start of a session and probably when the session's about to close. And then we can see here that volume starts to increase now as we get into the European session. So this is the main, I believe, 8 a.m. when it all kicks off. Everybody who's everybody is now got their finger on the button, right? So we can see that by the higher tick volume. Now, of course, because it's occurring at a low, right? We're posting a European low with higher tick. We're going to expect a reversal, right? But like I said, we want to be patient because what are we looking for is for the market to come and take liquidity. Now, we can go short, right? So you can see the market rallied in Europe, right? Very low volume on the way up. And then all of a sudden, a major US center opened and then we put a massive down candle with very extreme volume. Right, so this typically tends to be the New York Open. If it's not the New York Open, it tends to be the NASDAQ Open. You're going to see these kind of extremes. The New York Open is 1 p.m. The NASDAQ Open is 2:30 when the NASDAQ stocks open. Right, so you're going to get a lot of liquidity in currency markets at those times. But I pay attention to New York, the 1 p.m. because you see a lot of action there, and also pay attention to 12 noon, which is kind of pre the New York Open. Right, so we want to pay attention to those times. But you can see here that we had a lot of flow, and that's what I've marked out. There was very extreme volume. We created somewhat of a gap, right? So basically by that I mean the prices, the market didn't trade back into these prices basically. So we had a big flow. We didn't go back here, right? So that says that there's a lot of what's the word we tend to use? There's a lot of unfilled orders sitting here. But this is on what in market profile. Again, I have a separate program on that, and we'll talk a lot more about market profile as we go down the line. But in market profile, we call these unopposed selling, right? So we've found a scenario of unopposed selling where the market is sold off, and we've seen prices that are untraded. And so if you look within the body of the candle, you can see that the low of this candle, which is this one here, you can see the low. We haven't traded those prices since, and you can see the high of this candle here leaves a big, so there's kind of a lot of unopposed selling where we haven't gone back to attack orders there. Right, so that tells us there's a lot of power pushing this market down. Now all we need to see is a tick under at the bid, right? We know this isn't the lowest price of the session. So we can see this candle here, the low is higher than the low here. So if we start to trade bid prices into the European low, then that's going to lead to a trigger of stops, and that's going to push the market lower. Right, so that's your trade, right? Your trade at this point will be a break of this candle's low, where all the volume is, and the European low would confirm that, because then you can short it down to catch the liquidity. That will be your final target. You don't want to push it beyond that, because we're probably going to trade stops and grab liquidity. Now on the flip side, you could decide that I'm not going to take that trade, I'm going to wait, and then as the market progresses lower and trades liquidity and pauses and then closes back up, or you can buy at this point and then wait and then just hold and wait, or you can wait to get confirmation sorry, which will be a pause. Sorry, I've got a bit of my throat is a bit weird today. I've got a bit of a cough. But you'd see a pause and we rally, right? So you can decide how you want to execute. But the one thing that you can confirm is that we've traded where the stops are, we've hit liquidity, and the market has showed some resistance. And you can see that from the slightly higher float and higher tick volume from the prior volume. So we went up, volume dropped off on the second one, so we know that there aren't a lot more activity in this bar than there is in this, so this low is probably not the final low, and then we push in a newer low, but then we peak up on the volume, not as high as this, which would say the sellers are definitely strong up here, but definitely we're starting to see short covering, and that is indicated that we're going to get a rally, right? Because we're seeing a slightly higher volume creep in. So when we get this candle close up, that's the confirmation, because I tell you what, if this market was going to keep sinking lower, then we'll just bid, take out the bid low, and then continue much lower. However, that didn't happen. We reversed and then we held. So usually as we open and we start posting higher prices, then we want to try and get long. And then that should take us to the next session, right, as we discussed. So hopefully this first example here makes sense, right? So if you remember our step 1, when we've checked all of that, developed a bias, everything else, as you can see, guys, none of that mattered in today's trade. In fact, the bias was bullish, right? So if you go look at the previous lessons where we spoke about long-term bias on cable, it was bullish. So you would have made money on the short side, you'd have made money on the long side. So what did it matter where the market was going? So as an intraday trader, sometimes it really doesn't matter. Even if you have a long bias, it doesn't matter, because for example, this day the market was long, but it wasn't a really big day, right? So we're long in Asia, we had a spike into the US session. The volume is nowhere near the volume we're seeing here. I mean, it's pretty low volume, but the market continued higher anyway, and that's great. But then you would have been fooled very quickly into thinking this thing is going to chuck for the earth. Yes, the bias played out here in that we could have been better positioned to buy against the liquidity, but if you were a seller here, you can't possibly complain if you knew what you were doing, that okay, I'm going to get short here on the ticks and I'm going to cut short cover and then I'm going to go long, right? More money. So the more you understand what you're doing, right, and you're not just following blindly when someone says, oh, do a top-down view and if it's long, only go long. You have to be smart, because maybe this was your trade. Maybe you needed to go to the supermarket on the NASDAQ open, then take the trade, cover, get the money, go do what you need to do, and forget about this day. This was a good trade. Just put it in your journal. Say, you know, this was a good trade, good liquidity hunt. I missed it. I went shopping, right? So you keep that in the log, that this was an opportunity that played out, but you just needed to go shopping. So I hope this example has made sense, and we're going to look at some more examples. Okay, so let's take a look at the second example, or second proof, we should say. Right, so again, we took the very next day. So we had the conversation. So we hunted liquidity here. Market pulled up. If we're going to liquidate, it would want to be in a session. So you could get out here, for example, on the open of a session, or you could get out here. But we're going to talk about this. So again, if you were able to see Asia, you would already mapped out the Asian low by the time we got into the European session. So you can see the volume had already started to peak to signify the open of that session. So we can see that peak in volume there, and we posted this red doji-like candle. Right? You can see that here. So again, what we'd like to do is we would like to mark out, because that volume is very extreme, we wanted to mark out where that was. Now you can actually see, again, we wouldn't be trading because we saw that. We're not going to just take a position. And can anyone tell me why? I'm sure you can, but think about it for a second, and then I'll tell you why. I'll give you the answer. So I can imagine you guys already, in your mind, you're shouting out the answer. And if you're still wondering, you don't know why you wouldn't trade from here, then the answer is quite simple. You can see where the stops are, right? So they're going to be buy stops here and buy stop losses, right? So for people who are short. And if you look lower, there will be sell stop losses here and sell stop losses here as well. So being short here doesn't make any sense. Whilst on this day we see Asian market has been driven up and we tend to see a short cover, which means Europe is down, it is not always the case. Because again, this has started to play into a larger time frame. If you think about all the volume that was trading here the prior day, this is obviously traders who are long here at very extreme volumes with the hope that this market is going to go into a higher time frame in terms of direction. So for me, it wouldn't make sense trading against them. If they were going to be wrong, I would like to see the liquidity being hunted down here beneath their stop losses. Other than that, I wouldn't be short. Again, we know that there's stop losses here, but we know the best stops are going to sit here, right? And of course, we would probably see some action here, but again, this is the main one, because the difference between this price and this price is actually very slim. So if you were a market maker, you just strafe the whole thing, right? You're not really going to worry about, okay, I'm just going to hunt these stops here when there's a ton up here and there's a ton up. You're just going to strafe the whole line. The prices are really tight and close, so you're probably just going to go through them all. Right, so that's the area we want to be observing. So here you can see we had this big flush, right, in the European. We posted the European high, right? We don't know that yet because we hadn't slipped into the US session. But as soon as we slip into that session about here, we can now say this is a European high. So we've mapped out the Asian high and the European high and the Asian low. Right, obviously we traded up the top, took out liquidity. This would have been a good short position, for example. You'll be forgiving for being short here. However, as we pull into where this flush of orders came in, right, we can see that area start to act reasonably as support. So if we look at the volume build, so we started to push lower initially. Initially volume kind of tapered off for about 3 hours. And then we got a spike right here, right on top of where those sellers were, and they initially got broken. Because again, what would have been above these sellers? This is a squeeze. This is what we call a short squeeze. They got short, they got squeezed, liquidity was found, buyers got squeezed, came back down, and then we see this small spike in volume. So again, I have a whole individual course on Udemy that talks about volume, just exclusively about volume. So again, I haven't been covering it here in the same way, but I'm hoping that you're going to learn it dynamically as we go, right? So you can see that we got this spike here in tick volume, and that tells me that we're seeing more buyers coming in. It's quite late in the day, and then the market kind of just supports to the end, right? So if you were short, what would you do? You're coming to the end of the day. You know, we're seeing increased volume towards the evening and basing against what was evidently a short squeeze initially. What are the chances that people are going to still want to get short, right? Yeah, we traded liquidity here, but again, look at the volume we're trying to get short against. So again, towards the end of the day, it's just not worth it, right? So you might want to cover that trade and then see how it goes the next day. Right, let's say, for example, you thought you're in the heat of the moment. You're not thinking this is going to go sideways at all. You're very excited. You think you're going to make this happen, right? And you held on. But then you wake up in the morning, right through Asia, and then you see the market coming against you here. What are you going to do? Just break even the trade and get out, right? Because if this is going to go lower, we're probably going to see another liquidity hunt, and there will be another opportunity to get short in a liquid session. There is no point hanging on to the trade, right? So these are some of the dynamic decisions you have to make in Forex, right? But again, you're not going to be right on every trade. If you didn't make that decision and the market moved against you and started to go into new highs and take out the European high from the prior day, then just kill the trade. Your losses are going to be significantly smaller because you're thinking this way, right? But again, it's obvious to see that if we combine the information we're getting, we can pretty much get in a decent trade, right? And then obviously the break of the European high would have created a short squeeze for people who are trading, who are in the best possible position. So again, you know, there was an opportunity here, right, for you to get long and then drive this, right? Because you can see that squeeze, right? But again, like I said, I always prefer to trade from the most advantageous places. But that's just another way that you can look at it. So as a trader, you want to build a lot of playbooks based on your understanding of the market. I can't say this enough. There's so many people trading and they're following these very narrow and linear systems that people, educators and people have given them. They're not looking at it the whole board. You see, when I'm teaching you here, I'm trying to tell you about dynamic thinking. Look at it this way. There's no right or wrong. You know, you might want to get out at this point, and I'm giving you a logical explanation why you'd want to do that. I'm not just saying get out here because, you know what, I get this hunch, right? It happens to me every time, so I always get out there, which is what you hear people say. It's like, you know, as long as you've been trading long enough, you're going to know, right? You're going to see this stuff happening, and then you're just going to be like, I probably should just instinct. I'm just going to get out here, and then you look like the best trader in the world. This is not fair to someone starting out, because they're not going to be able to understand the nuances. But like I said to you, the logic is simple, guys. You hunted liquidity, you broke back down, you started a support, it looks like the market's tripping, it's going to go lower, so you get short, right? So you get short maybe down here somewhere, right? It's about maybe, it's a little above 125.40. Let's say 125.50. Market's pressing down, and you're hitting blocks and you're basing, you're about to get out. Like, anybody should be able to tell you that you can hold it into the next session like you did the other day, and that paid off, right? But look at the difference in the way this price action looks and the activity here relative to what's going on here. One, the volume's lower than the volume here to start with. Like I said, you're playing against bigger fish. We can clearly see that there was already been a short squeeze, right? So the people who are trying to get short have already been squeezed. I mean, what's the chances they're going to want to hit the sell button again? Right? The smarter guys who have a very systematic have seen the liquidity hunt and they're short. So they're probably in profit at this stage, but now you're dragging on. You've seen a spike in liquidity, which isn't normal, right? Not towards the evening, and that's formed a hammer candle. That looks a bit odd. Right? It's not much in the way of volume, but it's enough to signify that someone could be heading for a continuation trade. We can also see that, well, if this was a buy order sweep that took out shorts, then it means that there are probably a lot of strong buyers sitting within this body here as well, right? So the open of this candle will be pretty good support, because if this is not people getting short, which if they were, this market would have collapsed. I mean, look what happened here, guys. This would have just dropped off the fence. Currency doesn't wait about. There's only so much consolidation you're going to do before the whole thing keeps crashing down. So we don't want to put any more faith in this, because we're dragged to the end of the day. And like I said to you, let's say that you overlooked all of this that I've showed you, right? Everything we've spoken about was just overlooked, and then the market broke, which was clearly, I think it was about 8 a.m., right? You see this big bull move, flush of orders going long, right? Off strong volume. Your first instinct is like, gee, right? You're already now in negative P&L. What are you doing? Get the hell out. In fact, the way the structure's set up, we're about to take out the European high where all these orders were sitting, and we got a big flurry down here. Clearly, these guys are pushing the market. And what's the other thing that you would have noticed? Right, so it's about your understanding of the market. I'm going to tell you. You would have noticed that this happened in the US session, right? So we've seen a huge spike in orders, right? About 2:30. What happens at 2:30? What happens at 3 p.m.? At 2:30, the NASDAQ opens. You know how much dollars are going to be traded there as people getting in and out of stocks? In Chicago is when the Chicago Mercantile Exchange, that's when most of the traders come there at 3 p.m., right? Which I think is about 8 a.m., 8:30, which is when, you know, the Chicago exchanges all kick off, all the pit guys as well, right? So these are the biggest and strongest trading sessions, and look what's going on there, right? And do you really think these poor European traders are going to be able to cause much damage to what has been a significant show of force in Chicago, where the CME futures are for pounds, euro futures, all of these guys are there, right? Where the big banks are going to be trading. I mean, God, you know, let's think about it. Anyway, let's move on. Let's move on to the next example. Okay, so proof number 3, let's push it to the next day, right? What are we talking about? So again, we know the stops are up here, right? European high, mark that out, Asian low, right? And then we get this flush of orders at the European Open. So again, we want to make note of that, right? And we know it's heading to take out this. It's setting up as a continuation trade. And then we break through, right? So we see we break through on very low volume. And what's that telling us now? Well, when we're not even in the US session, and we're already breaking the European high. There is no, this is a strong liquidity area, but we're not seeing us come back in and settle. So we're not seeing any selling. So there's no indication this is going to break down. We come into the US session, another volume is much lower than the prior day as well. So we can tell that if there were any sellers here, they're not very strong. They're not really going to push this market too far. But again, look at it. It's complete candle, complete close, flurry of orders. Again, we can see the first time we've seen double order flow. Orders rushing in from Europe. Orders rushing in this late in the game from US. And then what happens at the end? We consolidate. We don't come back to trade lower. So clearly, there's been a massive intervention here. There's been no liquidity hunting going on. The algorithm has decided to just spool prices higher, right? And that's triggered everyone who's tried to get short up here. It's triggered them into stop loss positions. It's a bloodbath. Now, this kind of behavior tells you that the longer time frame's in control, because we're not seeing the intraday volume like we saw here. Instead, that volume's tapering off day by day. And this is the importance of watching this volume. Now, when you look at it as an aggregate, I mean, look what's going on here. It's tapering off. Look at this. Now, this is very uneven. Now, we're getting sporadic behavior. We've seen people sporadic, buying in Europe, and then we tapered off and we start to see spikes as we're about to start the US, but we're not really trading any more volume in the US, and then we get a big spike and then a higher candle close. So you start to pay attention. This could be a multi-day move, right? And we can see there's a lot of volume coming in the evening. I mean, when was the last time we saw that? Right? Look, and then we're consolidating, right? Now, of course, if you were on this trade, for example, there's no indication that you should have been trading long. You're not trading in Asia. You're waiting for liquidity on here. You didn't get it. So this day, more than likely, you wouldn't have had a trade. But if you were watching against yesterday, that there might have been a low risk reward payoff if you're expecting continuation based on your bias, for example. But again, this is not a way I would have traded it. I probably would have waited and then realized, okay, we're getting continuation. Let's see where we're going to get the next sell-off. Right? Because obviously there's nothing I can do. The market's running away. Right? Whilst obviously I can see here that there's no seller appetite. So I shouldn't really be trying to chase this market down unless I can see that some serious liquidity has been taken out. So as a day trader, you've made some money. You might want to sit out. Right? You've seen the price action today. We're going higher. You don't want to be chasing because you're going to get those whipsaws in, through the next couple of intradays. So maybe, just maybe, you want to sit on your hands. Right? So that's how you get to make those decisions. Right, let's look at proof 4. So Forex is hard, guys. So I guess if you've seen the stock video and you're looking at Forex, it's hard. It is hard. It's not the same as trading stocks. Right? It's hard. Okay. So let's have a look. Right, so we come into the next day. This is a very interesting, unusual day. So here we get the Asian low, the European high. We can see where the stop losses are. We can clearly see that through Asia, we took out the liquidity. We came into Europe, very low volume. Right, you can look at it in comparison to the other days, even lower volume in Europe. You don't want to touch anything. You already know what the gig is. Right, you can see that there's no sell interest. Most of the buyers were 2 or 3 days ago. We haven't seen sellers return. There is no interest in hunting liquidity to the upside. The algorithm seems to have a mind just to keep going up, spooling prices higher and higher. So what are we looking for? Let's see if we can get a liquidity hunt. So we've posted the European high and the Asia low. We know where the stops are. You see the market go up, and right here you see a flurry of orders coming, and then it pushes the market lower. So we can clearly see here that we have now settled onto the short side. Now you can get short, for example. But then look what happens as we go lower. We see a big flush, a pause, the market holds, and then starts to break upwards. Again, just look at the volume, how high it is. And it's coming in at low bid prices. And what happens here? What's underneath here, guys? I haven't marked it out, but what's underneath here? They're going to be sell stops. We trade under, we trigger liquidity, and then we start to pop higher. So now we're trading around this area like there's no stops. It doesn't matter, highs, lows. This is all done. There's no There's no sense anymore in being on the short side. So what are you going to do? Close out your short. You get long because you know this was a continuation trade, for example. Like, you could do that. Or you could just close out your short for pennies and then just sit it out. That's what it looks like, guys, when the market is spooling higher and it doesn't give a damn anymore about hunting stop losses. Right? And why is this happening? We can see the volume here has been governing it, and every day we've been tapering off, and this day we get something strange, a little bit of sell interest, only for them to get squeezed out again, right? Because the buyers come in and choke them. And we got a short-term liquidity hunt, and we're ready to move higher. So immediately that tells you the next day we're going to probably start to spool higher. So now my bullish bias is really strong, right? Because I'm not getting bullish on the basis that, you know, oh, I've just been seeing prices going higher. What I'm getting bullish on is the fact that the behavior of the participants is disgusting. They're taking out shorts left, right, and center. And every time the shorts try and gain control, they literally waste them. Right? So it's showing the bullish sentiment is strong. But let's see how the next day fares on. Right? Same thing. We always want to be moving the needle. The Asian high, European low. We always want to be marking that out. So what do we get here? We see again, stops are going to be here. We should expect liquidity hunts. There's going to be stops here. There's going to be stops here. European low. What happens in Asia? The market trades down. What do we get? European low posted. Even lower volume than the prior days. Look at that. Right? But it's on a bullish candle. So again, you can see there's a volume spike. Virtually nothing in Asia, and then the market does this bull candle and closes. So again, we know there's going to be orders here. This is like big money moving, right? Continuation perhaps. We don't know that yet. Let's wait and see. If we break the European low, you want to go short because the stops are going to trigger here. It's going to be a sense that, well, possibly at this stage we might go hunt liquidity to the base, but then we'd want to consider if this was going to be a short trade, this is where it will happen. Right? And also, what would that signify? It will also mean that the shorts somehow regain control from the prior day, and that could be the sign that those guys down here are starting to take profits and get out, which means the turn is near, right? So we would have probably noted that. But instead, volume tapers off right through Europe, we consolidate, and then what happens? 12 noon, right? So as we drive in a pre-market, we already start to see buyers showing up. It's 12 noon. Now, why do you think this is happening? It's happening because of what I like to say, information asymmetry. The people have found out that the pound is going up. Like all the traders now who've been looking for moves and they can't find moves have floated from other currency pairs and they're coming into the pound. They want to be the first in the game, so they're already up bright and early, coffee in hand, waiting to go long. Right, so 12 noon, we get that spike, right? And then look what happens. We start to close a lot higher. Boom. We're on the Asian high. Can you imagine? Right? We barely started the US session and we've already pushed up. That is telling you that all we need to see is the Asian high to go and no return, and this thing's going to go higher. Right? That's what it is. Your long term, you've got that confirmation from the prior day. So what am I looking to do? I look to play this long now. It's advantageous, right? We've been extending for a few days. What the hell? It's advantageous. We can see at 1 o'clock that intensifies, right? So we get more volume. Now you might think liquidity hunt coming. It doesn't. We start a spool up, and then we break the high. That's a strong sign we're going to continue. And then finally, we get this huge explosion, the biggest volume we've seen so far, stand here, right? So now we know there's something changing. Again, this is where the liquidity, we don't want to be short until we're underneath this line, guys. These are crazy prices at this point. So again, we need to be paying attention to that. There's a lot of selling here. This is a climax. So at this stage, we know that something big is about to happen. It's not yet. It's late in the day. We need to see first. We need to see what's going on. But we know that again, we can see that double order flow. Buyers here, Now sellers are coming in. Let's take a look. Proof number 6. Right, so we've now, as you can see, we've gone through several days, guys. I'm big on proof. I want to show you how it all works. So now we come into this day. We got stops here. We can see this stops all wiped out, squeeze. People getting short here, short squeeze, all good. Right, then it didn't matter. Even if you got short here, right, and you got squeezed, the moment we ticked above this, get out, reduce your losses. Right, so if you're really trying to chase this, then you made a small loss. What the hell? Now we posted towards the end of the day. We posted a high, of course. Stops are going to be above here, right? Liquidity. We trade that liquidity in Asia. We start to move lower, right? By the time we get into Europe, the highest prices are up here. I mean, think about this. The market's been trading down from Asia strongly. Let's look at the liquidity. So as we get down to the bottom, we post the European low. You can see here that there's an increase in liquidity here. Look at that spike relative to Asia. So that's immediately telling us, and what's beneath here, that's going to be stops, buy side liquidity. So here, I'm paying attention, right? See that spike in volume? There's got to be stops here. We can see the market starts to tell those, and then it pushes higher, right? Again, it's showing us the upside, but what do we know is here? Stops. We don't want to trade this. We can trade this long, of course, right? And that will be the natural thing, but it is so spiky. So we've seen buyers here, a liquidity hunt here, hit the tail, go long, get to the top, trade the short-term liquidity here with the stops, back out, cover that trade. Now what have you got? You can see a pattern developing here, right? We've taken the liquidity here, gone down, failed, taken some more, but failed to take out the Asian high, and then we settled for the day. Coming to the next day in Asia, we're breaking down. Immediately we take out the European low. We want to execute a short trade. So we're seeing a pattern now, right? So we already know that being short, it was very similar. So if we go back to the other slide, let's back it up, right? That was the exact same thing that happened here. The exact same thing. We pushed up in Europe, a lot of volume, we broke it down. Took out liquidity, rose. I'm going to show you that's the exact same thing that's going to happen here. Wait a minute. Let's go back. So you can see we bought, settled, came into the next day, and then what happened? Right? You can see us breaking that. You get that flush of orders. You can clearly see that. Lots of unopposed selling at this point. And look what happens. We get that spike. We take out the European low. That's your cue, guys. You just want a good price now to go short. And what do? We take out the stops, liquidity, and then go long again. Exactly picture perfect to the other day. The algorithms don't know how to do anything else, guys. And what came with that? Look at that spike in volume. That's also telling you there's a massive bullish bias here, because look at all the activity we've had to go through on the upside, and look at the weak effort from sellers. Right? When you look at these highs, there's nothing there. Just liquidity grabs and then look down. And where do we go? This was a good advantage. This good short play to take advantage of as we start to crack into these lows. You could get short, a lot of volatility. It would have been a hairy ride, but then we grab liquidity and then settle. Just buy it. We're under the European low. We've grabbed liquidity, posted a doji, popped out, came back down, settled. Right? So it gets really volatile. You can see that. We had volume coming in here, opposing volume, much bigger coming in here, and then big buy side move. It looks like they're shorts, but we don't see any continuation. What's that telling us? We've hunted liquidity. A lot of people have rushed in early. There's been a lot of churn, probably from the stock market, and then now we've settled. This is a long, guys. But it's really done. We're going higher, right? And where we're likely to go with this kind of volume trading, then you can expect that we're going to be able to trade back to the Asian highs, right? This is where the liquidity is sitting now, right? We know that already. We can see the attempt, right? So that's going to be our target. So I hope that this has made an awful lot of sense. I know to a lot of you guys who are new to this, you're going to have to watch all of that again, right? Sometimes I talk very fast, but go over it again as much as you need to, because what you're seeing there is what you're going to be dealing with Forex if you are a Forex day trader. Now, if you don't think that you can handle that way of thinking, you don't think you can put a plan in place that allows you to look for where the liquidity areas and maybe just trade from those. If you're like me, you're a lot of experience, you're quite analytical, you could probably take advantage of some of the short trades we explored, right? That were counter trend trades clearly to the longer time frame bias, which was bullish. Or you could have sat and waited for those bullish biases to play out at those low level liquidities. You probably had maybe 3 or 4 trades that week, maybe 3 trades, I think, and you would have made a lot of money, right? Because then you would have maximized. Those were sure bet trades. And if you're thinking about, oh, which trades were going to be the short trades, I don't really think I caught that. Well, this was going to be a short trade, right? If you got a bullish bias long term, then you buy at the lowest liquidity point. The moment we saw this, long, right? Make a decent amount of money. You don't care about the volatility that came here. This is a new day. We could look at how that day played out too. But if you're looking at that, you clearly see there was a liquidity hunt here into Europe or into the US session, and then we closed above on a massive volume, right? So the moment we ticked higher, you knew you needed to be long. So again, if you had a position from here, you just hold it. You've already seen this, right? So you know already this was just confirmation that we were going higher. So this would have been your sure bet trade. That's one. Let's look at another one that would have been interesting, right? Let's go back. Right, it's not these. You wouldn't have traded any of those days because there was just no signal. But let's go back. You would have traded this day, right? So those are 2 trades. You'd have made money if you'd maximized, put the trades you were going to do across the week. You just done it on those 2 trades. Then that's it. You got 2 trades from the 23rd or from the 22nd, sorry, all the way to the to the 30th, right? So over the course of 8 days, you did 2 trades, but you made good money. So you don't have to trade every day, of course not, right? Because you're looking for the best possible opportunities. Or you could have had more trades, but no more than 2 in the day. I always say there's no more than 2 trades in a day in Forex. Anyone who's trading multiple trades and telling you they're making millions, you're just stupid. They're probably not. It's a scam. It's fake. And this is the stuff we have to deal with, right? So again, you can clearly see you might have been able to grab this one and then grab this one, right? But on other days, it would have been choppy. You might have been long here and had to cover early. It was messy. It was choppy, right? Or if you were short, you might have held that short, for example, right? But it was choppy because you could kind of got mixed signals. So you would have traded against yourself a lot, right? So you can see that here. This didn't look obvious. This was a breakthrough continuation trade. So if your idea was to look for short squeezes when you know people like me are wrong and that's the play you want to go for, then kudos. That means you like to kill. You like to, you know, it's Mervyn Capital style. For those of you who saw the stock thing, yeah? You like to kill the firms like Mervyn Capital. You like to go after the big fish. And if you want to do that, then you've got to be prepared to get hurt. Right? So again, if you like to squeeze trades, then you can focus a lot on looking for these squeeze trades. So when you get consolidations like this, where the signals are mixed, you can dig deep, right? You can see there was a buy side here. We were tailing in. We're going for a break. It's a good play. You get long. You have to adjust risk. You're not going to get much. Remember the probability of ruin matrix. I mean, where's 2 to 1 in here? I mean, you barely got 1 to 1, right? Before you were running out of this trade. But you want to squeeze people, so squeeze them, and you're not going to get much of your money for the squeeze. So you're better off waiting for those A+ setups, like the ones we just explored, right? But you could also go for squeezes, but they're definitely not A+ setup. In my opinion, squeezes are Bs, because you're going to make mistakes when you're trying to squeeze out big fish, because they're going to fight back, right? They're not lame ducks. They're going to fight back. Right, so again, you can see that these were the kind of trades that were probably your bread and butter. Right, so it's about also Forex is hard because you're having to make these kind of decisions. You can get good at it. You can definitely make some money, but again, there's always easier asset classes to make money in. It's hard, right? Because you see how switched on you need to be, how selective you need to be. Because the algorithms in this market, they're aggressive. You know, they don't pull any punches. And you're using leverage, right? So they're taking you out. So homework. Now good. So let's see what we're going to do to kind of make all of this better. So you're going to go to a European currency pair, Eurodollar or cable, and look back at least 20 days and simulate your decision making following the steps that I showed you. See how those trades worked, record them in your journal, go back another 20 days if you like, until you've got enough information there to verify that what I've just told you is the truth and nothing but the truth. So anyway, for those of you guys who've watched the movie A Few Good Men, and you're old enough to remember that, which is one of my favorite films, Tom Cruise and what's his name? Some of you would probably already tell me, but I love that movie. It's a great film. Yeah, it's amazing. But anyway, if you remember the line from the movie, it's the truth, absolutely the truth and nothing but the truth, right? So this is kind of where we are. So anyway, I want you to go back and research, do your own research, have confidence that what I've told you here is going to help you. Exercise 2. I've had a grammatical error somewhere, so let's go through it. So check the highest volume on the hours, compare this across currency pairs. So what I want you to do is go back to an hourly time frame, look at how the highest tick volume, and then look at what the market did next, but also compare it to some of the other asset classes across currency pairs, right? I want you to do that. That's important because it's going to help you have a sense of what currency pairs are most active in different open settings. So you're going to go, for example, to dollar yen, and you're going to find that what the volume you see there is going to look a lot different to what you see in cable, because a lot of the traders trading dollar yen are probably trading somewhere between the US and the Asian sessions, right? So you're going to see a lot more activity there. So I want you to compare, so you start to get a feel as to what currency pair you could trade based on your time zone or where you live. If you're an American, you know, start considering US, but you can still trade cable. As you can see, there are some great opportunities. In fact, some of the best opportunities in cable came in the US session, not in the European session. In the European session, there were a lot of squeeze trades. So what we saw is a lot of people rushing in early and then getting squeezed out in later sessions, right? That was more or less evident as we look through the stuff. Hope this has been useful, guys. So far, I hope I'm making sense with all of this, and this has proven to be an amazing resource. Like I said, just share everything. You know what to do. Share everything. If you want to keep getting these lessons, you got to subscribe. Otherwise, you won't know. And you have to hit the notification bell. If you don't do that, you're not going to know when I put these up. But in any case, guys, enjoy, have fun, and see you on the next lesson. Adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?